Well, let's start with the introductions first. My name is George Zarya. I'm founder and CEO of Bequant. We're exchange custodian and recently launching a prime brokerage service. So that's what our panel is going to be about. So we have panelists representing the exchanges, one of the largest and the most influential exchanges in the market, and also Ed from the market maker. So we have both sides, the buy side and the sell side present. So hopefully it'll be a productive conversation. So Josh, why don't you start with the introductions with yourself?
Sure. Hi guys, my name's Josh Goodbody. I'm the Director of Growth and Institutional Business for Binance. I'm sure you've all heard of Binance. I don't need to introduce the firm. We are a global company and we are, of course, very involved in providing different services to the institutional market space. So, yeah, very pleased to be here.
Hi, my name's Phil Glover. I manage the business development efforts for our institutional clients for OKEx. Similar to Binance, probably doesn't need too much more of an introduction either, but we do spot, derivatives, recently just launched options as well.
Hi, everyone. My name is Lester Halali. So I'm the head of the institutional business development for Huobi. So I cover all the Southeast Asia, Europe, and America for all the institutional client and key client contact. So I'm based in London, and I also work as the general manager for Huobi Europe and the strategy director for the group. Yeah, so that's it.
Hi guys, my name's Ed Carlton. I am head of digital asset sales at Flow Traders. Flow Traders is a proprietary trading house and market making firm with a very strong pedigree in the ETF space, but we've kind of grown over the last 3 to 4 years to be one of the more aggressive and dominant market makers and liquidity providers in the digital asset space.
Excellent. So prime brokerage in the traditional markets has a very sort of a central role. So, I mean, the notion of the crypto industry was grown off of decentralization. How do you guys see this increasing pressure to consolidate and concentrate in the one sort of infrastructure units coming into the space in the market? I mean, do you see this trend happening?
Yeah, I think what we've seen is an increasing trend to replicate certain market structures in crypto, right? So what we've seen is, we've seen prime brokers come to market. We've seen traditional custodians starting to build very institutional focused products. We've seen a replication of some of the market infrastructure that we would expect to see. Prime brokers obviously being a very important part of that world. Prime brokers cater for a number of things, but principally, efficient capital management is one of the key things that they do. And bearing in mind the way that the crypto space has kind of evolved over the last years, and we've seen a slow but steady stream, I would say, of institutional clients come into the space. To cater for that kind of client, you inevitably have to have some kind of support infrastructure that accommodates that, right? So I think prime brokerage is definitely one of those areas that is increasingly important. I think one of the interesting topics that we'll be able to talk about later on is who's doing a good job at that, where the pain points are, and where potentially some people are getting it very right. But it's a very important piece of the jigsaw, I think, in the crypto space.
Yeah, I would agree with that as well. I mean, I've been in this space for about 12 months, and just to see the changes that have happened during that time, especially from a prime brokerage point of view and a custodian point of view, and where there were possibly issues before with maybe fragmentation of liquidity and security issues, I think some of the solutions now that have been worked on by some of these custodians and prime brokers is only going to help to help marry that bridge, build that bridge between the traditional space and the crypto space.
Yeah. So on Phil point, since 2018, we already run the institutional business, and in the past 2 years, I think Huobi we onboard almost like 400 overseas institutional clients. But what we see the trend is like we see a lot of institutional clients. They usually like to directly connect to our exchange, no matter Huobi, Binance, or OKEx, but not through the prime brokerage, because we see the most institutions coming in the industry are still the high frequent trading institutional client. For the high frequency trading institutional, for example, like those large family office or endowment fund or something like that, we see it's still in very, very small scale to enter in the market. For some number, like Grayscale, last year, 2019, their AUM increased from 1.9 billion to 2.9 billion. So only 1 billion increase in 1 year. It sounds a large money, but I think in the traditional institution, it's so small, right? And also like CoinShares still like around 1 billion size, become the largest Bitcoin checking fund in Europe. So my point is like the traditional large family office or endowment fund, they are still quite slow into the area. And because the prime brokerage, the custodian, and all the lack of product to sell to this traditional large institution. But for the trading institution, they are entering the market, but more they prefer to directly connect with us rather than through prime brokerage.
I think when you're looking at the landscape, you have to almost divide it into two sets of schools of thought, and one of them is the kind of the crypto maximalist, the Bitcoin maximalist, who believes in a completely decentralized world. And you know, back to your question, you know, it's almost quite contradictory to think that we're looking at this system that actually revolves around something that's very centralized by nature. So there's that side, and then I'm probably going to slightly unfairly say the realistic side, which is kind of where more of us are kind of coming from, and that element of realism is, okay, if we really want to create something which is a fair, a transparent and competitive market, then there's some problems in the market at the moment, and one of them, which Josh already alluded to, is I guess, capital inefficiency, the ability to manage your treasury positions, the interoperability between exchanges. So for us as a market maker, you know, we're active on over 15 different exchanges across the globe. You know, these exchanges at the moment are fully, you know, by and large, fully funded, pre-funded exchanges, and with a rather interesting network of fiat rails and crypto rails sitting, you know, between them. So, you know, you've got this kind of a solution to a problem which you want to take a more realistic and pragmatic approach of how we can grow that. But I do think there is an element of, look, you know, you have to realize this doesn't really sit with the dogma of something which is completely decentralized, and as some of the founding principles of cryptography and crypto were.
Yeah, I would definitely agree. The centralization of the industry is pretty much imminent, especially if we're talking about the institutional segment of it. So we have the panel of institutional experts here. So you guys are, I mean, we started touching upon the pain points, right? So the problem of the capital efficiency, right? That's a very obvious issue that has been happening here. What about other pain points that you guys see are being the bottleneck for institutional players to come into the space?
Yeah, what about connectivity? As an exchange, we frequently see that clients are saying, okay, your infrastructure is completely different to other exchanges whose infrastructure is completely different to other exchanges. So you have a really diverse spectrum of exchanges that have completely different technological infrastructure. And the problem with that is, you know, you end up having these disparities. So for example, for like HFT firms or for large hedge funds, their challenge is frequently reducing the latency of their trading. For them to be able to do that efficiently is a very time-consuming exercise. It's also resource demanding. They've got to code and develop to each individual exchange. And in doing that, it means their time to market to get up and running and trading is extremely challenging. So one of the key areas that we'd like to see the industry kind of working together is how do we create an infrastructure that allows people to get connected to everybody as quickly as possibly. That's sometimes where prime brokers come in, right? They may provide some kind of market access solution. We haven't seen something yet that has the full-rounded prime brokerage solution, in my view, yet, but we are seeing lots of market access providers trying to build a harmonized, low-latency infrastructure, giving wide market access across the board. That hasn't happened yet. It's definitely in the process of happening, and I think if you can mix that kind of frictionless market access with a proper credit solution or some kind of capital efficiency solution, you've got a really interesting offering.
I think it's interesting you go to connectivity is kind of the first thing. I mean, I think for us and what we're seeing a lot more, there's a more fundamental issue which needs to be addressed, and that I'd probably put down as counterparty risk as quite a broad term. You know, in terms of not just from your on-screen trading, but definitely more so from your OTC trading and kind of a DVP model. You know, we've got a lot of exchanges, venues, liquidity providers popping up where you have a certain limited recourse on your counterparty risk. Part of the reason why centralized clearinghouses, prime brokers were set up was to alleviate that risk on the settlement side. So before you even get into the fun intricacies of co-locations, what fixed gateways you're using, etc. I think for a lot of these institutional guys looking to get in, and I'm firmly of the belief actually that we don't have that many truly institutional guys in this market at the moment, other than some of the HFT market makers and then a handful of custodians. Definitely from the buy side, I think we're still at that age of getting in some of these kind of traditional institutional guys to the market. And I know for a fact that a lot of the concerns which sit with them are probably first and foremost counterparty risk as opposed to connectivity.
Yeah.
Well, the counterparty risk, actually, this is a question for the exchange participants. So in the traditional markets, we have the settlement cycle is T+2, T+3 typically, right? So there's a more efficient, from the capital perspective, settlement structure. You mentioned DVP as well. There's no DVP in the crypto space. There's no post-trade settlement available. It's all pre-funded model. So you guys have any sort of thoughts or plans on looking on accommodating some sort of a credit line facility for institutional guys to use collateral more efficiently?
It's something that we're addressing now at OKEx. So we're certainly working on those kinds of solutions. We're starting to offer more credit lines now to some of our larger institutional clients, and I'm sure that model will roll out more and more as time progresses. It's a new thing for us, but it certainly addresses some of those issues and some of those problems that we're talking about. I guess like all exchanges, we're here to try and build the ecosystem. We want to work with our clients. We want to work with other custodians and prime brokers. And so we listen to our clients. And for our clients, if we can move towards that kind of T+1, T+2 settlement, then maybe that's the way we'll build the industry. But I guess it's just seeing how the market develops, seeing where it takes us. But certainly, some of the solutions we're seeing right now and us moving towards being able to offer these credit lines is a step in the right direction.
Yeah, I think it's like from our exchange, like we trying our best also like try to solve the capital efficiency or lend money directly to the high frequency fund. But we also see the market usually in two types. One is high frequency fund, one is a non-high frequency fund. But all these clients, as I mentioned, the first they think about is the counterparty risk because there's so many hacking issues in our industry. And while we already been in the industry for 6 years, so a lot of clients, they prefer to directly deposit a large amount of crypto into our exchange rather than, okay, why should I use only 1 or 2 year prime brokerage service when it's never been proved their service is safe, right? And also, if you use a custodian service in our industries, then for the high frequency trader, they will always say, okay, so how can I solve the latency issue? There's no way they can solve the latency issue when they put the money in the custodian and then another way trade on the exchange. And I also think maybe there will not be a centralized cleaning settlement scheme, something like that, because as you see, maybe in US in the future will be, and also you are more centralized, okay, because of the law, you need to settlement in one cleaning house, something like that. But I think in a lot of countries, no matter Africa, Asia, or something, there is no way that they will have a central cleaning house. So the cleaning settlement always happen in major big exchange like us, Binance, OKEx, and others. So it will make really difficult for the high frequency trader institution. Okay, I use one broker to connect all others. So for the non-high frequency institution, so the problem is like, okay, still they need to find a trustable prime brokerage, like what we know, maybe have Tagomi, Bequant, or other solution. But and it actually sometimes solve their problem. Like how can I manage so many accounts in different exchange? And also maybe they can do portfolio margin or other cost product margin or cost exchange margin easily by program. But as I mentioned last time, I said it's like I see the high frequency trading institute, they still enter in the industry in a really slow pace. Yeah.
Yeah, I think just to add to that, we see exactly the same, where at some point it would be great to see a really good prime brokerage solution that affords for connectivity and capital management. In the absence of that, us as an exchange, we have to build solutions that will somehow increase capital efficiency. And I think we're all doing that in different ways. But a common theme is things like, in futures we have cross-position margining, so you're able to efficiently allocate your capital when you trade futures. Across all of your positions, the next step is portfolio margining. I think a lot of us are looking at that as a model, working out how we can actually implement that within our existing exchange infrastructure. We all want to do it. It's a question of technology and we want to get it right. And then, of course, looking at credit lines. Binance has been looking at various credit models that we can offer to some of our larger institutional clients as well. So there are various inter-exchange models that are being built at the moment, and I think they're still in their infancy, but at the same time, in parallel, we're seeing these prime brokerage solutions being built for the future. So it's going to be interesting.
Yeah, totally agree with you. One point that we forgot to mention is the access to the market. So for participants, for the hedge funds that are just want to get in, it takes roughly 6 months to get onboarded with the major markets, and it takes massive resource from the compliance, from the risks, and relationship managers to reach out as well. So that's also an important pain point that we're trying to solve as a prime broker. In addition to the portfolio margining, which I think is going to be the next level.
Yeah.
It's not a particularly easy task to crack, because it involves basically tapping into a massive balance sheet. But I think the technology allows to mitigate certain counterparty risk issues. So when we're talking about usage of the collateral, for example, from the clients, right? Because of the blockchain transparency, we can actually provide that transparency to the client to see where the funds are based. So if I'm borrowing funds and I'm lending it to my clients, we can essentially trace where the funds are based, and the prime brokerage in general as a liquidity, as a treasury management function, becomes much more transparent. So I think in this sense, the crypto industry has a bit of a step up in terms of compared to the traditional finance, and I hope that there's going to be more blockchain tech will be implemented eventually into the traditional finance. But another point is the liquidity for the institutional clients, right? There's different types of clients that we're trying to tailor to. So the most typical ones that are have sort of entered the market quite early in the days is the market makers, arbitrageurs. For them, it's very critical to have the direct market access to each individual platform. It's usually a latency sensitive approach, and but then there are other types of participants that are looking to basically tap into the overall liquidity. So if we're looking at a large hedge fund that wants to buy for 100 million, 200 million worth of Bitcoin, currently it's very difficult to sort of come into one place. So and plus the industry is also this is sort of two trends that I'm seeing, and maybe you can share your opinion in terms of the fragmentation of liquidity. There's been more and more exchanges coming out, and new brands are trying to take a niche in the markets. And do you see the same trend as well? I mean, what do you think about the centralization of liquidity within the core sort of market participants?
Yeah, I mean, I don't know what you guys think, but I think this year we're going to see a bit of an inevitable creep towards consolidation of some exchange infrastructures and environments, because we've seen over the last few years a real fragmentation of different liquidity pools, whether that's within a region or even just ad hoc exchanges pop up now and then and create a certain niche market. That fragmentation, for the most part, yes, it's interesting to play around with as a retail trader, but at the institutional level, it's not particularly useful. So I think we're going to see a consolidation. What that will look like, I don't yet know. It will either be some exchanges will want to merge with some of the larger ones. Other exchanges would like to probably use the cloud solutions that Huobi, that Binance have, where you can utilize a cloud solution to access, for example, a central order book, instead of having a segregated smaller liquidity pool. I think that's going to be a continuing theme this year as well. I do want to mention DEXs very quickly, because this is an area that lots of people ask us about. Are DEXs going to be the answer to the liquidity question? Will DEXs fix fragmented liquidity? Maybe, but not yet. We still haven't found a way for DEXs to become a piece of infrastructure that institutions are happy trading on. And there are many reasons behind that, primarily because every single DEX runs in a different way, has different security infrastructure, etc. But I do think, as a general theme for this year, we're going to see a slow consolidation of volume, and it will probably actually end up landing slightly higher up the pyramid.
Yeah, I mean, it's definitely an issue, obviously. So if we're talking about attracting much larger institutions to into the environment, into the industry, these guys, especially if we look at big asset management companies or pension funds that are trading huge amounts of FX or commodities, they simply can't move the liquidity that they need to move in this market. Yeah. I mean, let's look at this positively. It's a growing industry, and it's come on leaps and bounds over the last year, and 2 years, and 3 years, and it's making great strides, and no doubt will be much further on in the next 12 months. But if you compare it to the size of the FX market, it's not quite loose change down the back of the sofa, but it's small potatoes. So they need to find a way of getting some of this fragmented liquidity together to create larger pools, so guys can come in and kind of swing the bat a little bit without having a huge impact on the market. Like Josh said, I'm not quite sure what form that's going to take. But what I do know is there's a lot of interesting solutions out there. There's a lot of companies working very hard to try and make that happen. Yeah. I don't know if there'll be a merging of any of the top exchanges at the top. I would personally be quite surprised if that ever happened. I still see more and more exchanges joining the market because it's just so easy to set up an exchange. And if we look at, if we take FTX and what they've managed to do in 6 months, that's only going to encourage others to perhaps try and emulate that sort of success. So I'm sure we'll continue to see more and more exchanges joining. But certainly I think that the main exchanges that are there at the top now, working very hard to build their liquidity pools, to continue to improve their products, to be innovative, and to offer a better service to the clients, and eventually try and bring over the larger institutions into the marketplace. So again, I'm not sure what form that's going to take in the next 12 months, but I'm pretty sure it'll be pretty exciting however it ends up being.
Yeah. So from our observations, like since the last 2 years, we monthly will see roughly maybe 30 to 40 clients, institutions are onboarding with us. So I'm still, the whole industry will still follow the trend. A lot of institutions still come onboarding on each exchange. And we see another thing in the new exchange or something, we see a lot of new derivative exchange. There may be, and through this new derivative exchange, from their sales network, maybe they bring more retail flow into the whole market. And then this retail flow concentrate this small and new exchange, and then finally end up aggregate together in big exchange like us. So I think the overall liquidity for the market will increase. And another one significant point, trend I see is like more and more traditional brokerage, like Robinhood or E-Trade or other. I would expect a lot of traditional brokers, they may be introducing buy and sell crypto for their traditional equity trader or FX trader. I think from their source, they may be bringing huge influx of retail liquidity. Yeah, and then as a partner, you work with this traditional broker, you also get a lot of new liquidity also. But from the institutional side injection of liquidity, I'm kind of did not see a good measure or new good product for them. I think it's like if I were a non-high frequency trade institution, I only looking for some product that, okay, I can have the position for crypto, but I don't need to deal with the custody or the cold wallet of or the private key of those cryptocurrencies. So I think this traditional large institution, they were still waiting like this traditional brokerage or prime broker, Goldman Sachs, Morgan Stanley, or BAKKT, or this more traditional institution. They launch some crypto product to help them enter the market. But I see this, I'm not sure how quickly this will happen, but maybe it will happen much faster after something like Libra or the Chinese National Digital Currency, DCP, after the issue. Maybe this trend will increase much faster. Yeah.
Let me rephrase slightly the question for you, Ed, because you're the representative of buy side. What would be the ideal number of exchanges for you? I mean, there's thousands of them, right?
Yeah.
Because you obviously you make money off of inefficiencies, right? Mispricings across different liquidity pools. But again, on the other hand, it's massively expensive to try to integrate into all of them, right?
To kind of loop back to something I said earlier, like, we're all trying to strive to get, a clear, transparent, and efficient market. And let's just kind of focus on that last word, efficient. Like, it's not efficient to have 2,000 crypto exchanges or how many there are nowadays. And I think, this, as I've said, I don't believe this to be an institutional market. This is still very much a retail-driven market. And therefore, a exchange-based experience, which is very much more like an equities model, where you have a lot of exchanges servicing a retail market. That's why it kind of works where it is now. And we might start seeing something further down the line with kind of, exchange members. So in the same way that you have a lot of brokerage firms who are London Stock Exchange member firms, we might start seeing brokerage as being, members of these respective exchanges here, etc. But I think the big thing I'm going to link back to is, again, counterparty risk and this kind of fear of counterparty risk. And until that gets solved with some either prime brokerage or just a general acceptance of some of the exchanges which are out there, I do feel that the institutional players will try and drive the market towards more of an FX-based model, direct connectivities, ECMs style approach, maybe some dark pools, which probably isn't, fantastic news for some of the exchanges, but it's I do think until some of these problems get solved, that's kind of where we might see.
Yeah. Well, we have a couple of questions, and actually one of the interesting ones is the topic of compliance in the institutional segment. So the question is, how important is the subject of market surveillance and AML compliance when engaging institutional clients? Obviously, it is very important, but maybe perhaps you can add some color on the...
Happy to jump on that one. I mean, the answer is obviously extremely important. I mean, for flow traders, where our core business is dealing, in regulated markets, we're a publicly listed, regulated firm. We have to make sure that we do everything to an nth degree. So that's kind of for ourselves internally. Now, dealing with, our counterparties or people that we work with, it's extremely important for them. If we're dealing with a new issuer and they want to know, where the provenance of the coins, they will ask us, where are the coins that we are providing them liquidity to, where are they coming from? And obviously, you get in some quite difficult dichotomies, and that that might be proprietary knowledge if we say, oh, we get all of our Bitcoin from this exchange. But at the same time, we need to be able to turn around and say, well, actually, we employ forensic blockchain analytics. There are, over the last 12 to 18 months, I've been really impressed by the progression of number of firms who are engaging in providing these tools to the industry. And I think that's actually one part of the industry where we've done very well. The elliptics, the chain analyses of the world, cipher traces, there's a huge list of them, and doing a really good, fantastic job to provide these surveillance tools. So I think it's extremely important. And actually, when they have that realization, that you can actually get greater depths of surveillance using blockchain than you can with fiat currencies, it's a pretty good marriage.
You guys have anything to add?
Yeah, I mean, extremely important. There's absolutely no doubt, I think, that institutional clients have certain expectations and standards that their exchanges and service providers have to meet. These, or a growing number of these institutional clients, are multi-asset. So they're doing the bulk of their business elsewhere in some cases. So they're used to seeing certain structures and standards being up, more or less up to scratch in the FX space, in the commodity space, wherever they're trading. So they expect that. And so I think a lot of these exchanges, the larger ones in particular, who've gone through a journey of understanding how they can future-proof their business and kind of drag themselves forward as much as possible in terms of putting in place, market integrity standards, market surveillance structures, whether it's on-chain analytics and forensics tools, internal compliance structures that are able to, catch and freeze so-called dirty crypto assets. All those very crypto-specific things have had to be implemented within, the broader, I suppose, market integrity work streams you see in other markets. That's slowly being done, and I think the exchanges that get it right are the ones that have the institutional clients right now. And I think speaking from a Binance perspective, we've been lucky to have, as I'm sure some of the bigger exchanges have as well, the relationships with clients that allow us to ask them, what do we need in the next couple of months? What do we need to be doing in 6 months to be bringing our offering forward? What kind of things should you be seeing from us? Is it, on-chain transparency as to how large our reserves are? Is it a third-party integration for a custodian? All those things, we're constantly speaking to clients to understand what it is they need. So I think really for institutions that are in the market now, and even more so for institutions that are coming into the market, the theme of compliance, market integrity, market surveillance is extremely important. And I think all the larger exchanges have probably realized that quite a long time ago.
There isn't really too much I can add to that, to be honest with you, apart from to say that, that particular question there around market surveillance and AML, and you can add to it the tech issue that Josh brought up earlier. You can add regulation into that as well. These are all different things that just add another layer of confidence for institutions to enter the market and feel comfortable that it's a safe and secure place to do business. Right. So it's just another one of those things, and it's important, and all exchanges are working hard to make sure that we have these things in place.
One more question real quick on the, do we need a complete ring fence between the wholesale and retail markets, or can they commingle? If I may start answering this question, I believe that these markets have to coexist as one. They complement, and the synergies between the retail and institutional liquidity in particular is extremely important for the entire marketplace. I don't believe that there's any rules that we should be applying or ring fencing. We are moving towards the structure of the market that is very similar to the traditional finance, and eventually we might see a complete sort of divergence of these two under one sort of framework, regulatory, technological, and regulatory as well. Yeah.
Yeah, I think it'll be a slow but steady, I guess, bifurcation of this world. I mean, I don't think we need to do anything drastic, put it that way, to split up wholesale, retail, and retail markets. I don't think it's necessary. I don't think it does anybody any favors. But what we may see, as you've alluded to, is that these structures will be created over time, and organically, we may end up seeing certain markets catering for more retail traders and other markets catering for more institutional traders.
Yeah, I think it will be more like they are commingled, because I think even you look at the traditional finance market, it's like even 80% in the US exchange, the trading from the institution, but still there are another 20% from the retail side. They mix together. And in China, right now the stock market is still more like the retail maybe account for 60 or 70, and the institutional only for 30. But as time develops, the institutional ratio will become larger. I will also say in crypto area, it's like because these two liquidity means together, that's why both, no matter retail and institutional, they are happy to come in. Because if you cut them out separate, and then for the institution, there will be too low liquidity for them to enter this market. And I think the overall liquidity issue in crypto is still quite small compared to the traditional, no matter equity market or FX market. So I think it's still a long time they will commingle together, I think.
Excellent. I think this is we're running out of time. Thank you. One more question maybe from the audience, if anyone.
Okay, cool.
Thank you very much. Again, great panel. I think we've uncovered the topic of prime brokerage somewhat in this new emergent space, and hopefully next year we'll be talking about the successes of our businesses and bringing the institutional guys into the space.
Right.
Thank you.
Thank you.
Thank you.